I'll get a couple of housekeeping items out of the way, but we're here to talk about not only the changes that are happening within the plans, but also why this is a good time to maybe evaluate your current retirement plan and is it meeting your needs. So my name is Tom Harty. I'm with Sikich Financial. I'm a consultant here in the Naperville office, and so my role is to help plan sponsors with their retirement plans from a compliance, oversight, investment, and things of that nature. We also have Gretchen Osborne. If you want to introduce yourself.
Sure. Thanks, Tom. My name is Gretchen Osborne, and I'm a manager in employee benefits here at Sikich. I worked in the retirement plan retirement plan administration and consulting for most of my career. I started in benefits in 1981, so it's been a long time. I started out, I was mentored in a Big 5 accounting firm at that time, and I also worked later for a major Chicago law firm. For EGTRA, most recently within the last restatements, we're talking about restatements, I worked directly alongside attorneys that were actually for a major document provider where we developed and tested plan documents, and that's where my love grew for plan documents. We did SPDs, we did plan communications. I loved the work that we did, and so I'm very grateful that I've been able to have a background not just in plan administration, but also in the design and development of plan documents. I love the work that we do at Sikich. I came to Sikich because of the expertise and because of the quality of the people that I would work with, and because of the quality of our clients. So I'm real grateful and very happy to be here today.
Great. Thank you, Gretchen. And we've invited Neil Shore from Shore Tompkins. He's going to talk about from an actuarial point of view.
Thank you, Tom. Shore Tompkins has been around. We're about to celebrate our 10th anniversary. I'm a founding partner at Shore Tompkins. We design, administer, and provide consulting services for qualified retirement plans. We focus quite a bit on a third of our retirement plans are defined benefit pension plans, including cash balance pension plans, which we'll discuss a little bit more in detail a little later on. My role is basically relates a lot to the growth of the organization, the design of retirement plans. Right now, there's the direction of the legislative climate has made these plans very flexible, and we're focusing on the design options and retirement plan options. I initially I have about 28 years of experience in this as an actuary. I initially came up with a large employee benefit consulting firm where I worked in the large plan markets. We basically service two types of retirement plans. Small, closely held businesses that might be using the plan as a wealth accumulation vehicle or tax saving vehicle for business owners, and alternatively we have plans that are designed more as employee benefit plans, and many are a combination of the two. So we've looked at this both from the employee and the employer's perspective.
Great. And so, as you can see, we have obviously two great experts when it comes to design, implementation, and how plans should be run, and have great thoughts regarding that. My background, I didn't say that in the beginning, but I spent over a decade at Fidelity, so most of my plan experience lies around the actual, how plans are run from a vendor perspective, working with participants, things like that. So a couple of housekeeping items as we get going here. There are going to be some keywords because we have submitted this for CPE credit. So there'll be 3 keywords that you need to write down throughout the presentation here. And the survey will be sent afterwards, and you'll have to give us those 3 keywords to get CPE credit. Additionally, a copy of the presentation will be sent following this presentation, so you'll have that in hard copy. There's some links that we post in the last couple of pages, so you'll be able to get there from that. So with that, we wanted to kind of dive right in. We thought we would talk about, again, a little bit more about how we help clients what is it that we can do and help them achieve their goals. We're going to talk about what PPA is, why we're talking about restatements, those kinds of things. So we'll give you some background and also the types of plan and plan documents that you need to be looking at and evaluating. Then we're going to open it up, and Gretchen and Neil I'm going to pose some questions to them, and they're going to give us their thoughts on what's going on within this discussion and how you may be able to, maybe questions that are on the top of your mind. And then we're in a restatement period for plans, and what does that mean? What should you be doing? And then also, how does that affect the plan design that you have currently? Maybe we feel it's a great opportunity to evaluate the plan that you have and maybe add additional features, look at what's going on, your business, things of that nature. So with that, we're going to get into how we help our clients. So from a consulting perspective, Gretchen's going to take the first half of this in terms of what it is we do to help clients.
Okay, thanks, John. So some of the things, and this isn't everything, but of course, ERISA has been amended dozens of times, and there have been hundreds of new regulations and rules. With CPA, we have a restatement that is coming up, and plans are going to have to be restated no later than, well, right now, what we think it is, it's going to be April 30th, is it 2016? Do I got that right, Neil?
Right, yes, April 30th.
Okay, so we deal with compliance and tax law updates like we're going to be talking about now. We may be dealing with, on any given day, problem-solving situations that are needed as they arise. We correct plan errors. We have worked with clients that need help with the self-correction program or the voluntary correction program. We've helped people who forgot to file Form 5500 or may not have forgotten, just not have been able to do it. So we work with delinquent filers, with the compliance program. We've assisted with audits by the IRS and the Department of Labor. We can help with plan termination. We review retirement plans with service providers. And we've also done some investment consulting and implementation. So I think the great thing about working with Sikich is that once you're a client of the firm at Sikich, that any one of us, there's always someone that we can, if we don't have the answer, we can knock on the door of a colleague here at Sikich. And it's really, really great that once you're with us, if there's a problem, there's usually some way that we can help you address it.
Great. And as Gretchen said, we know as plan sponsors, this is something that you spend time doing, but it's not what your day job is, and we understand that. And so that's the value of the folks here in the room is to provide that guidance. This is all we do, and so it's really helpful to lean on experts when you have questions and whatnot. So that's a lot of, we talk about consulting, that's a lot of what we do is just, we're a sounding board. We know things don't always go smoothly, and it's how do we make sure that things get corrected and that things are in place to make sure that those don't happen. So we also help clients from a design perspective. So now we talked about the consulting, but now we talk about what's the proper design or things like that. So Gretchen, maybe if you can talk a little bit about that.
Well, in terms of plan design, I think we both would have shared that we actually, I think the difference, what sets us apart, is that we take the time to understand a client's needs and wants, so we can tailor a solution that doesn't just address what they're immediately concerned about, but that works within the context of the client's long-term strategy. Wouldn't you say?
Yeah, absolutely. We were just talking about the direction of the legislative climate has made these plans very, very flexible, whether it be a 401k plan, a profit-sharing plan, a cash balance defined benefit plan, or a traditional defined benefit plan. Every client has specific needs, and it's so important to understand the client's objectives, who they want to benefit, what they want the cost of this plan to be, how much flexibility do they need in year-to-year costs of the plan. Then you get into the details of loans, hardship withdrawals. Who do you? What's needed to encourage people to participate? There's an awful lot of value associated, which we'll get into a little while. There's an awful lot of value associated with having these plans, both from the employer or business owner's perspective and the employee's perspective. There's a lot more dollars that's being added to people's pockets because of these retirement plans. It's a wonderful value for both an employee and an employer. And the key thing is to be able to provide the necessary flexibility and really help the clients meet their objectives. And I think plan design is very, very key to all of us.
And I think too, don't you think, Neil? There's plenty of, I guess, providers that will offer you a plan document, and that's all you'll get is a plan document that they may fill it out over lunch or something like that. And that's what sets us apart. The difference is that we do work with you, and we'll take you through what the design choices are and what they mean. Will the plan be individually designed for the plan sponsor, or is it going to be based on a pre-approved document? What do you really need? And where will the plan's money be held? Who's going to be the trustee? We think about all these things. We talk about all these things. Will the plan permit participant-directed investments? Who's going to be responsible for administering the plan? We take you through everything that you need to know, as opposed to just giving you a document to sign that you may or may not understand.
Yeah, exactly, and that goes along with a vast majority of the service providers have pre-made solutions. So they've already decided, should we have a pre-approved document, or should we have a individually drafted document? It's important to give the clients and plan sponsors choices with this regard. Sometimes a pre-approved document is the answer. It's less costly. Other times you might be spending a few dollars to be provided thousands and thousands of dollars of savings in value. The key thing is to really understand the client, and most of the time, quite often, these plans are being, as you said, Gretchen, it's being filled out over lunch, and here are the typical answers when sometimes you make small tweaks to the plan, and it might mean extra thousands of dollars of tax savings or an extra amount of flexibility in the design, not having to make a contribution if you don't need it. So it's absolutely important to have ongoing discussions with the sponsor, with the client, to talk, not just simply receive some data, spit out the answer. The more conversation, the higher the level of the consulting and the individual interaction, the more we can really, as organizations, provide value for the client. And a lot of this value is being ignored for a lot of these plans. There's great opportunities right now.
Yeah, and I think that, and I know you feel that way because I've talked to you, that we just try to approach each engagement that it's a lasting relationship. Even after a client leaves our office, we're still talking about them sometimes. We're thinking about them 3 days later when we see something that might be a good option for them. And that's, I think, what sets us all apart. And it's just, we love the work that we do.
Right. And I think when we get into the plan, some of the actual examples of plan design, we're going to be able to illustrate where we show the various objectives and how they're met.
Right. And one of the things that I neglected to say is you can type questions in, and we'll address those as we go. And if someone has typed in a question regarding, give us some examples. So a little bit later, we'll give you. Neil has a nice slide that has talked about the different types of plans and how you can use this to further the gain of the organization. And so there's a couple different ways to address that. So as we go, please feel free to type those questions in, and we'll answer those as they come. So I think the design aspect of it, not to beat the proverbial dead horse, but that is where we find the most glaring issues with plans. Is they were just sold a plan. Here's the plan. Get into it. And then when you dig deeper and you talk to them about why participation isn't where it needs to be, why aren't people saving what they should, why don't people value this to the organization, we usually find it's because it was designed poorly and it didn't have those goals and objectives in mind. So, and as your businesses evolve, whether you grow, whether you divest, you need to look at your plan to say, is it achieving those goals? What changes should we be making as we grow as an organization? So the last component, again, is administration. So this is more of the tactical, the day-to-day. So, this is, again, what people use both of our organizations to do. So I'll start back with Gretchen, if you can maybe outline a few things here as well.
Sure. Well, plan administration is all about the management of the plan. And one of the things is if you have a qualified plan, you have to make sure that the plan operations are consistent with the rules and with the terms of the plan. So some of the things that we assist our clients with, and what's great about Sikich is you don't have to go with something that's all bundled. You can just pick and choose what you need. We can help you with payroll setup and processing. We have some clients where we actually reconcile their payrolls and remit it for them so that they don't have to deal with that. So it's not a drill every pay period. We offer plan record keeping if it's needed. If you don't need it, we can work with, if you have a record keeping done for you, we can help with that too. We, of course, we're accountants here, so we do trust accounting, make sure that everything is reconciled to the trust. Compliance testing, all the non-discrimination testing that needs to be done. We deal with government form filings, for example, Form 5500. And we have an area that deals with distribution and loan services. If you want us to help process or determine whether a distribution is eligible, then we have an area that can actually review your plan and even talk with the participants. We work with employee communications, and we also provide training for plan sponsors.
Gretchen, it might be worth mentioning, we started before talking about plan design, now we're talking about administration. The two kind of go hand in hand when we initially put in the plan. A plan that we designed or that we initially install, what's the likelihood of having compliance testing down the road? What are going to be the options if we do have issues? We certainly don't want to, as both believe, we don't want to surprise our clients and the plan sponsors, or certainly have negative surprises. Positive surprises we're all for, but quite often what we try to do is look at down the road if the demographics of the group were to change a little bit. How will that affect the compliance testing?
Right.
We don't want this to be a crapshoot, basically. We're basically trying to provide an awful lot of value for the client, provide flexibility, and the administration goes hand in hand with the design. Are you going to offer loans in-service distributions, hardship with distributions? All of the administration and the plan design needs to be looked at one point at the same time when we're initially designing and installing the plan.
Great. That's so as you can see, we started consulting, so that's again looking big picture. Then you look at design is now as we get a good idea of what it is the organization is doing, how do we design an intelligent plan, and then with all of those things that Neil just talked about, flexibility, looking ahead, and then how does that make the administration of that? Because I imagine many of our folks on the phone here that this is where the rubber meets the road. This is where issues come up, and this is where maybe you find some challenges. Is the administration of the plan that was set up, is it meeting those needs, and is it doing what you need it to do? So with that, one of the things that we thought of is, so why do we do this? Why do we have a retirement plan? Why should we go down this road? What's the benefit? And so Neil provided a slide, and hopefully you can read this, but essentially the message is...
Yeah. Well, the basic reason for retirement plans or any sort of employee benefit plan generally comes down to the most important factor is taxation. It's a tax-effective form of compensation. There's also other issues as far as retaining and attracting employees, but the ultimate reason for having a qualified retirement plan are all the tax advantages from both the employer, the business owner, and the employee's perspective. Let me back up for a moment. When an employer puts money into the retirement plan, they get an immediate tax deduction. The money that's put into the plan is not taxed to the employee until they take the money, until they distribute it directly from the plan or directly from a rollover IRA. All of the investment earnings that are in the plan, that's not taxed either until the money comes out of the plan. If you're an Illinois employer, the money coming out of the plan is not taxed to the employee at all. So basically, it's the company is getting immediate tax deduction, and all of the money is grown tax deferred. What does that really mean? We come across sometimes, people that look at this from two perspectives, and there's not always an appreciation of the true tax savings associated with putting money in a retirement plan. Gretchen, I know you've heard the same thing, where some people will initially look at a plan design, see all the money that's going into the plan, and say, wow, this is wonderful, it's tax-free. Well, it's not really tax-free, it's mostly tax-deferred. I've heard somebody on the other extreme say, well, what's so great about this? You put money in a retirement plan, you're going to have to pay taxes eventually. So there's really not always a great appreciation for what is the tax-deferred, federal money grown tax-deferred buildup, what is that really worth, what is the tax-free components of the state income, from state income tax perspective, what is that worth? And I want to use a simple example here. Now, keep in mind, we're looking at this from one employee's perspective. Think in terms that an employer putting money in for the business owner might have greater savings. Let's, in this example, look at this 25-year-old who's earning $35,000 and would like to save 10% of the salary, or $3,500 per year. If the money is invested in the 401k plan. Right now, we're looking at an employee putting their own money in the plan, and let's assume that this employee is getting a 4% salary increase each year, and each year they're going to put 10% of the money in the plan. You could see after year one, realizing the money is coming out throughout the year, the $3,500 that was deferred might have a balance of $3,640. If you go to the right column, alternative 2, if the $3,500 is taken out with after-tax dollars, you're going to have that same $3,500 is going to be taxed immediately. Well, if the person pays 20% federal income tax and 5% state income tax, they're only going to be able to keep 75% of the $3,500, and then if we account for maybe a half a year's interest, if the money's coming out throughout the year, they might have $2,694 at the end of the first year, while they have $3,640 in the 401k plan. So now, each year, we're putting in another 10%. The money that's going in after tax is being reduced. You're not really quite getting to invest 10% of your salary or the $3,500, because some of the $3,500 is being taxed. And some of the investment income is being taxed. So by having the money grow in the 401k plan, alternative 1, as opposed to outside savings, there's basically 3 effects initially. You're having more money to invest, so you're earning more interest on a higher balance, and your investment earnings is not being taxed. You're getting a higher investment return on more money that's being invested. So there's a compounding effect. And if you do this year after year, let's look, if we bring this down to age 65, notice that the balance in the 401k plan, again, assuming each year we're saving 10%, the balance in the 401k plan is $1,680,000. If you invested the same amount of money outside the plan, you only have $680,000, if you can see at age 65 at the bottom of the illustration. Now, the person is ready to retire at age 65. Well, they're not going to, they really shouldn't take all this money and pay taxes on it immediately. Let's assume the person is retiring at 65. They might live till 85. And on average, the money comes out at 75. Well, the $1.6 million that they have in the 401k plan, they'll roll it into an IRA where it continues to grow tax deferred. And if on average the money comes out at 75, we have another 10 years of investments, so the $1.68 million might grow in 10 years to $3.6 million on average. The money outside the plan is growing at an after-tax rate, so the $680,000 might grow to about $1.1 million. Now, the money in the plan has never been taxed before, so now we're going to pay 20% taxes, or $725,000 of federal income tax. We're not going to pay state income taxes in Illinois, and Illinois is not subject to state income tax. So that leaves us about $2.9 million in the 401k plan, while the same investments might have only provided about $1.1 million if you invested outside the plan. So here this individual has about 3 times as much wealth, and it's really a conservative story, because the truth really is when people don't invest in the retirement plan and they invest outside, well, one is, does the money get invested immediately? A 401k plan is going right into investment and it's being invested immediately. Are people truly going to invest for their retirement if it's not in the 401k? Or are they going to buy a car or buy a purchase or live a higher lifestyle? So that's one question to ask. The second question is, even after retirement, different people have different levels of income or different levels of retirement security. For people that are fairly well off, the money in the retirement plan can be rolled, upon death, can be rolled into spouses' IRAs, children's IRAs, where it might grow tax deferred for decades. Under the latest laws, when it's rolled into children's IRAs, they might have to take nominal amounts out, but if they're going to live several decades past their parents, it's that much more tax savings, and perhaps maybe other money, if the retiree is fairly well off, they might want to use other money before using the retirement savings. But the bottom line of the story is that by investing in the retirement plan, you have all this because of all the tax advantages, you accumulate so much more money for wealth.
And I think, as the baby boom generation retires, and I think that's the generation that has a lot of catching up to do, is they're taking care of their parents now, and they're taking care of their children. And so the real value of 401k savings is going to become apparent, as this generation retires. And I think that all of us are going to be seeing that.
Yeah. Absolutely. And the more, the more every employer not only should get the value of having their own money grow tax deferred, or the owner's own money, there's a lot of appreciation that can be sold to the employees as well.
Right. So I know everyone here knows the value of a 401k, but that's somewhat lost on participants. And so I think this is just a reinforcing example of what does happen, why it's important, and things of that nature. Our first code word is PPA, so you need to write that down. We did get a question on taxation, so we're going to look at that in a minute here, but we wanted to get going on the PPA. What is PPA? Why is this important? Why are we talking about restatements and things like that? So, this is on our doorstep right now, and so this is something that we need to address. So, Gretchen, if you can kind of give us the highlights here.
Sure. So as Neil just mentioned, qualified plans get a tax deduction. People who participate in them are entitled to tax benefits, and therefore there are certain rules the plan sponsor must follow in order to have a qualified plan. And that's where we come to the plan document. The plan document sets forth the plan terms that the employer is required to follow. To establish a plan, for those of you that don't have plans yet and you're wondering, well, how do I even get started with this? To establish a plan, the plan sponsor, which is usually the employer, has to execute formal plan documents. And the plan documents, as we mentioned before, can vary from complex individually designed plans to simple prototype or other types of pre-approved plans. And so, but in short, the plan document, you can't have a plan without a plan document. You have to follow the rules. And the plan document actually sets forth in writing the plan terms that the employer is required to follow. So what is PPA? What does that stand for? That's the Pension Protection Act. And the Pension Protection Act includes all of the rules that have, since the 415 regulation. Hey, so can you hear us? Can you hear us okay? Thank you. We had a little audio trouble. Why don't I just back up to where we were talking about, Neil talked about, qualified plans, and in order to get a tax deduction, people who participate in them are entitled to tax benefits, and so there's certain rules the plan sponsor has to follow. And so to establish a plan, the plan sponsor, who is usually the employer, has to execute formal plan documents. And the plan documents can be individually designed plans, as Neil mentioned, or just simple prototypes or other types of pre-approved plans. But in short, what it comes down to with plan documents is that they set forth the rules, the terms that the employer is required to follow.
And I think it's important to point out, and again, this is something that gets lost quite a bit in providing retirement plan services. When there are restatement requirements, I can't say how often sponsors just simply get brand new documents. Well, at the point in time that the changes of the magnitude that are required by the Pension Protection Act, raises other questions. Is the plan really meeting your needs? How much income is appropriate when you consider pension, 401k, Social Security? Is the plan really meeting the design, all of the design issues? Each and every provision should be really looked at this point in time. It's an ideal time, to get a feel, to re-examine the plan. And the key thing is, compared to, even the last time plans needed to be restated, the direction of the legislative climate has made these plans, certainly more flexible, more options. They certainly should be addressed at a point in time that you're restating the plan. There was a question that came in. Why don't we address, going back to the prior illustration? The question was, isn't an advantage of investing outside the plan the fact that if you have certain capital gains type income, you basically that's only taxed at 20%, while money in the retirement plan is being taxed at the ordinary rates. And normally, when we do these types of analysis, that's something that that's one of the considerations, that when we look at the after-tax return, we're assuming that after tax, the return on the investments outside the plan is a little bit higher than the after-tax return coming from the investments inside the plan. And there's a lot of other things that are going into it. For example, when you're investing inside the plan, you have a lot more flexibility to change the investments around over the next 40 years, while each time you change the investments when you invest outside the plan, you're going to be taxed immediately at that point. So in some respects, there's some advantages of investing inside the plan. And for example, if you're investing outside the plan, you want the total investment to be for capital gains. It's not really likely that someone's going to have one investment for 40 years and not realize that sometimes throughout.
Right.
But the question is that's being raised. There certainly is, at certain points in times, you would anticipate a little bit higher after-tax investment rate by investing outside the plan. It's relatively nominal relative to the value of having all of that money grow tax-deferred, and the fact that state income taxes is not taxed at all, and the fact that it can continue to grow tax-deferred after retirement. But the point is accurate, that that there is some, you do lose the capital gains advantage when you invest inside the retirement plan.
Okay, so let's go back and talk about the plan restatement for PPA.
Restatement's the second code word, so we'll talk about that. Oops. There we go. So plan restatement. So what is it? What is the plan restatement? We got a little bit about that, but I guess why is this important to us? What should we be paying attention to at this stage?
A plan restatement is, well, you know, plan documents have to be updated. We talked about all the rules and regulations. So plan documents have to be updated from time to time to conform with all the changes in the federal tax laws made by Congress, or to reflect regulations, you know, with the Internal Revenue Service or the Department of Labor. And the last mandatory restatement period for pre-approved plans was April 30th, 2010. That was the restatement for what we called EGTRA. So since then, there have been a number of regulatory and legislative changes that impact retirement plans. And we talked just a minute about, you know, what those were. We talked about the Harty Act, RIA, and PPA. So that's what this is all about. If you have a new plan, your plan is going to have to still be restated for PPA. If you're getting a new plan, you want to go to a document provider that has a document that is ready for PPA and that has the language in it. And anybody that has an existing plan, you're going to have to restate. We call that, you know, it's a complete rewrite of the plan to bring it up to date. I think you're going to need to have everything since the 415 regulations for these new plans that are being restated.
So do we have to do it? Is it voluntary? Can we decide not to?
Oh, yes. Nope, there's no, if you want to have a qualified plan, that's the rule. You have to go by the rules.
And the one way to look at it is, you know, there's certain costs as far as an upkeep of a retirement plan to keep it in compliance, and there's service providers. And one of the things, again, when we get further into the plan design issues, we're going to provide some examples. When plans have to be restated, there's a little bit of time and there's a little bit of cost associated with it. This is just needs to be viewed as the cost associated with getting a very, very large tax savings for the employer and the employees. When these plans are designed right, and most plans are, the tax savings associated with having this plan far outweighs all of these administrative costs. They're really relatively nominal relative to all of the tax savings that these plans produce. But that's basically the cost associated with it, having to the upkeep of these plans over the lifetime of them.
Okay. There was a question that came in, and I think we could probably put the name of any provider in here, but it says, is there any problems relying on a Fidelity or whomever, you know, that provides that restatement to their plan? Is it what's the benefit, or what should we be looking out for when you say, well, Fidelity is going to just push this down to us?
Well, the issue is, and we'll pick the person might be picking on Fidelity, but it could be anybody. And again, it depends on the service provider, but typically the investment companies provide the least amount of flexibility in the plan design. You have to fit into their box. Now, sometimes, more than sometimes, in many cases, somebody doesn't need any sort of creative type provisions, or maybe they need a very, very vanilla plan. But quite often, as a general rule, the bundled service providers, when I say bundle, these are organizations that are providing the investments, the plan documents, and the compliance work. Usually you get the least amount of flexibility. Now those service providers provide more flexibility now than they did 15, 20 years ago, but they generally don't provide some of the flexibility that we're going to be talking about when we go through some design options. So the answer to the question is yes, they could do it, and they certainly, there's no reason they don't do it accurately, but you lose a certain amount of flexibility.
Yeah, this is one of, if you want to irritate me, just bring in a document that you don't know where you got it from that tells me your whole history, your whole document history. Is that, you know, there was a provider that gave you that document. It was a simple pre-approved plan, and you got it for no additional cost. And as long as you kept the assets invested with the investment firm or the company, They charged you a variety of fees for providing and managing investments, and you got that document for free. And that really diminishes the value of the document. The document, is more than just signing off on it and having someone, hand it over to you. It's really about, understanding the rules and regulations and making sure that you know that the plan conforms, in operation. So I do think that there is from my personal perspective, I think there is somewhat of a risk sometimes when you go that route. Absolutely. You need to be with a knowledgeable provider, a provider that understands the rules and regulations and will keep up with you. If there's an interim amendment that's needed, if there's something that they need to advise you about with a document, that if you call them, they'll know what it means.
Right. And it's funny. I just had an example of something that came up in the last week or so, a couple days last week. An example where it was a bundled provider that you have to fit into their. If you use the bundled provider, again, you have to fit exactly into their box. This was a client who was a litigator, who some years they might make $1 million, some years they might make $0 or $200,000, and the owner of the company said, gee, I need to live on $175,000 a year. Well, we showed them ways that they might be able to contribute several hundred thousands of dollars into the plan, and by going with a non-pre-approved document or an individually drafted document, we were able to write it such a way that to the extent that the owner's salary or compensation exceeded $175,000, the pension contributions would kick in. To the extent that their salary was $175,000 or below, just being a litigator sometimes doesn't make a lot of. Some years, if they don't settle a case, they may not make a lot of money. If they earn under $175,000, the plan read that the plan compensation is considered zero and the pension accrual is worth zero. So there's certain things that you could do to really help clients meet their needs at certain times when you have the ability to use individually drafted documents. You won't get that with the bundled providers.
Yeah, I think if you have an individually designed document, make sure you have an ERISA attorney. That's what's key. I think the documents that are pre-approved and that are out there, they're excellent. They're really, really well done. And they've come so far, and there's a lot of options that are out there with this new, with PPA documents that are coming out, that there's really no reason why you wouldn't want one to go with a pre-approved document, in my view. Having worked with attorneys on them and having seen the problems and having tested them and worked with actual administrators who have to administer them.
So all this strikes me as, okay, what's the cost of this? And, am I better off just relying on a Fidelity to provide that? I mean, what you say, it sounds all good and well, but it sounds actually more complicated, or it sounds more expensive. What are the alternatives for people from a cost perspective?
Well, a lot of it depends on the client's needs. The route of having a creative plan design, and again, we're going to in a few moments show some options. In administrative fees, it does cost more. Gretchen or I would never suggest a plan that costs $4,000 more than another plan to provide $5,000 of value. We're looking to provide significant value to the plan sponsors and the clients, and there are scenarios where a low cost plan makes a lot of sense, and there are certain scenarios where it doesn't. Depending upon the client's needs, we talk about is it worth having a Fidelity plan where they may not be charging? Is it worth having a simple design? I'm throwing out numbers that might cost a couple $1,000s a year to administer. When is it worth spending a few $1,000s extra? Both of our organizations could provide a plan for under $2,000 on an ongoing basis. We also have plans that might cost $5,000 or $6,000. We're basically looking to help the client, the sponsor, meet their needs. We would never suggest the $6,000 plan when the $2,000 plan meets their needs. Conversely, typically the tax savings associated with the $6,000 plan, when it's appropriate, could be worth millions of dollars down the road of additional retirement savings. So what does this cost? The answer really is it depends. It depends on what the client's needs are, how much flexibility is, how much they could afford to contribute, and that helps us determine what type of plan they should be putting in and what's appropriate.
And also, I think you have to think about the level of service. I know at Sikich, that if a client calls me and they have a question about the plan, what is compensation? What does that mean? They get an answer and they get it quickly, and we help them sort through their options when there are problems. So, and that just when you're a client of Sikich, that just comes with it. And that's important, that you get that insight, knowledge, perspective.
Right.
Well, and it's not even just one is the knowledge. There's also we both have benefited from just the overall level of being proactive and being responsive. Many of the bundled providers, and again, or perhaps maybe some of the CPA firms, you call an 800 number. Are you going to get somebody that's going to return your call that really has any idea of the details and the history of your plan?
Right.
And with the Sikich approach, or Tompkins, you're generally going to have someone that's been working on your plan, that's knowledgeable about the exact situation. It's not some 800 number where anybody could be answering your plan. It's someone that's very, very familiar with what your needs are and can efficiently get you to the to the right answer or solve a problem efficiently.
And for me, I guess, to address, there are some very, very good providers. Like my experience, I have worked with Fidelity. They're an excellent provider, and in terms of if you do have a document with them, I haven't seen a lot of problems with a lot of these good investment providers. The problem is when the documents get in the hands of people that aren't qualified to work with you on it, right. And that's I see the trouble.
Right. Yeah. And sometimes they are qualified, but then they don't know. They don't know what they don't know,
right.
And suddenly they're not. There's an opportunity cost that's being missed.
Or
we could have done this, or we could have done that.
Perhaps it's an attorney, a very qualified attorney, but it's a very qualified corporate attorney, and the plan sponsor may not know that the corporate attorney does not have a background in ERISA. That's an issue. That's a problem. If you're going to go with an individually designed document, make sure the attorney has a background in ERISA.
So I think we're going to move to an example and probably spend the remainder of the time talking. Neil provided an example of what a design change may look like. As you talked about, is there's a cost-benefit analysis. I think an important feature is, as Neil discussed, the bundled providers, looking at who is servicing your plan and not just saying, well, Fidelity, Vanguard, Zero, whoever does everything, and you feel, well, I'm comfortable because they do everything. We're not suggesting that you need to move from those types of providers. It's find the ones that can help you in certain areas. And so they don't have to write your document for you. You can have somebody review that. They can still record keep, and that's an entirely different discussion. So sometimes people confuse that. And again, I worked at Fidelity, so I get kind of a hall pass to tell you about a little on the inside. We wanted to make you feel like we were doing everything for you, so that was captured, and the more people that were involved, potentially the worse that could happen there. So I think seeking the right professionals in certain areas, and as everyone has said here before, it's really, this should be about you and your plan and your participants and what is in their best interest. As fiduciaries on the phone, that's the standard to which you are held, is we have to view and do everything in the best interest of our participants and their beneficiaries. And so it seems silly, but a plan document, you've got to look at what the best option is for you. And it might be simple, and you at least went through a process to evaluate, say, wow, it was as simple. Restatement. This is a slide that Neil put together, and he's going to go through kind of how, as you're evaluating the plan itself, what changes and how you may change the different features to provide different benefits. And in this example, it's a wealth accumulation vehicle. And so we're going to talk about ownership, privately held, ownership. But you could plug in many different things that you want to have happen, and the outcomes will be slightly different depending on who you want to favor. So if it's all about the employees, not about the ownership, there are different changes you could make. But understand, this is just one example, but it's multiple examples to achieve whatever the goals of the organization are.
Right. And in this particular example, and obviously every client has a different subjective and different demographics. But in this particular example, we're assuming that there are two owners and a spouse of one of the owners, and the primary objective of the plan is to use it as a wealth accumulation vehicle for the owners of the family. And when I say wealth accumulation vehicle, I would say that a plan meets that objective if we could somehow quantify, like we did, quantify the value of having the owner's money grow tax deferred. And if that's if we could put dollar amounts on that, and it far outweighs the cost to provide benefits for the staff and the fees to administer the plan and any time that might be involved, then it's a wonderful wealth accumulation vehicle. And we're assuming that in this particular example that that's what the objective is here. If we initially jump to alternative 4, which I'm not going to get into the details of how all of this is being done, but here you have a scenario where the owners are getting $485,000. The owners and the spouse are getting $485,000 contributed, and the aggregate cost to provide benefits for the rest of the staff is about $50,000 total. $52,000 looks like. So the short story is, if the choice was not have this plan, not have plans at all, let the owners have $537,000 of additional income, pay taxes on that, and then maybe go out and invest it, versus have only $485,000 go to the family, but have that money grow tax deferred and to some extent tax free. What's really happening here is the government is fully paying for the cost of the staff's benefits and a good portion of the owner's benefits. And I mentioned earlier that the state income tax is tax-free, that 5%. So you put in $500,000 into the plan, you're saving about $25,000 tax-free. That more than covers everybody's fees, just what they're saving tax-free in state income taxes. There's also actually another tax-free component. To the extent that the owners are taking less salary to pay for all of these plans, they're not going to pay either the employee or the employer's share of Medicare tax on its way in or out. So in other words, if an owner perhaps was going to take a $500,000 salary and is now going to only take a $300,000 salary, he's not going to be paying the 1.45% Medicare tax. Remember, there's two halves of it, because the owner pays half as an employee, half as an employer, even if all the money is going to him. So it's really costing 2.9%, although a portion of half of that 2.9% is tax deductible. So you might be saving about half the taxes, another 2% tax-free, just due to the Medicare taxes. So what I was trying to get on this last point is that if you just look at the tax-free component and forget the fact that you have all this federal money growing tax deferred, that itself is going to pay for the cost of the fee of the plan. But I want to point out a couple of design type issues that come up, where I kind of show some of the things that Gretchen's organization does very well. Let's look at alternative one, which is the profit sharing plan that's providing each employee a little over, at the bottom it gives the formula, a little more than 10% of pay plus another 5.7% of pay on the portion of your salary that's over the taxable wage base. And then for the owners, I'm also sticking their 401k deferral into this as well. And you could see in alternative one, in aggregate, the owners are getting $143,000 for themselves, and the aggregate cost for the remaining staff is about $100,000. This first plan is a pre-approved formula, safe harbor formula. Fidelity, anybody could use this plan. And it requires no special testing. There's two ways to prove that a plan is non-discriminatory. One is have a pre-approved formula, or one is numerically prove it. This one is a pre-approved formula. I would say that if we did an analysis similar to that 401k analysis that we showed earlier, having $143,000 grown tax deferred for these owners would still more than pay for the cost of the benefits for the staff. However, let's go to alternative two, a non-pre-approved formula, and suddenly we're giving the owners the most generous benefit allowed by law. The staff is all getting about 4.43% of pay. Now, when you don't have a pre-approved formula, one of the components of the testing considers the fact that when you put $1 in a fund for a 20-year-old, it buys you a lot more age 65 accumulation than when you put $1 in a fund for a 55-year-old. So that's what's allowing us to provide the owners a lot more as a percentage of pay than the remaining staff. And in this example, we're providing the owners just about the same amount of benefits while cutting down the staff's benefits by about $70,000. By the way, Gretchen, correct me if I'm wrong, as far as administrative fees, alternative two might cost, what, $700, $700 more than alternative one?
It depends,
yeah. Whatever it might be, but if it's $1,000 more, here they've just made a very modest change to the plan, and we've been able to save them about $70,000 in staff costs. Now, a Fidelity nowadays could do things like alternative two, but one of the things that Gretchen is very strong at is in the plan. In the plan design, really looking at the details. Sometimes there's issues of who's in the plan. Should people have to be there on the last day of benefit? Should they not? Sometimes giving a few extra dollars to the staff really saves a lot of dollars, and those are things that we look at. So the point is that we don't have time to get into the exact details of all these plans. There's a lot of creative things, and typically it's worth, now that plans have to be restated, it's certainly worth looking at these sort of options depending upon what your true objectives really are.
Particularly with profit sharing plans, with our documents, our pre-approved documents, now you can put each person in their own group, and that gives you a lot of flexibility, especially for plans that want to be able to offer more to the people that have put more into the company, and be able to offer more of a generous benefit.
So the last word, because we are out of time at this point, is contribution. So that's the word that you're going to need to write down. So your 3 words. And as we said, the survey will follow, and we will have you can add those 3 words into that to get CPE credit. We'll also get a copy of the presentation that will be sent out as well. Again, we apologize for the audio portion of it. As you can see, to summarize, there's complexity, what seems to be complexity, but what it is it's really figuring out the goals and objectives of the organization, and starting with more of a consultative nature of what it is, what you're trying to do, and then working through the design. And it has been said many times throughout, you can get a standard prototype boilerplate plan design from any quality provider. That's a starting point, but depending on the needs of the organization, that may not be the right solution. So engaging a professional to at least be a sounding board to see what changes might happen. And as Neil outlined, he was just taking one approach about wealth accumulation. You could look at approaches of, well, how do we maximize the benefit to participants, not necessarily the ownership? How do we, how do we lock up the key employees for the next generation if we're going to transfer that? How do we add different components? We just have a 401k plan. How do we add a cash balance? How do we add a profit sharing? How does all this work? And how does we can do that at the most cost-effective price point? Our next webinar is going to be September 10th on common compliance issues. So for everyone here, we thank you for your time. Feel free to reach out to us with any additional questions. But we appreciate your time and look forward to seeing or hearing you or listening to us on the 10th.